All right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormack, founder of Better Books, certified tax planner, CPA, MBA, husband to Jasmine, father to Maverick. Excited to be here with you. We are getting a lot of feedback around the podcast. We've made some serious changes, some serious developments, and we appreciate all of the insights that you provide us. Please, if you have any feedback, maybe there's topics you want covered, maybe you want to leave a review, subscribe, share it with a friend, whatever you can do to help us out is greatly appreciated. We do like to hear from you. We do read reviews and comments, and so please don't hesitate. If it's not so friendly, maybe leave it to the direct messages. No need to go public with that, but if it is a friendly review, we'd love for you to leave it so more people can see it and learn from it and hopefully check us out as well. Today we're going to be talking about the life cycle or the year's cycle of what your tax plan should look like. Most real estate investors, most entrepreneurs worry about taxes once a year, and it's far too late. Especially if you're making six figures, especially if you're making seven figures, your tax plan should be as important if you're in the real estate space as your next deal. I've talked often about the four pillars to every real estate investment. One is cash flow, right? We all need and want cash flow in our investments. And if it's not cash flow and you're not making money, you're losing money. And so you're leaving money on the table, opportunity on the table, because there are properties that would be cash flowing for you. The second is appreciation. We hold for the long term. We want our properties to appreciate. We buy in opportune areas so that appreciation is possible and more than possible, probable, and more than probable, almost definite. So we have cash flow, appreciation, leverage. We do believe that tapping into the leverage and the debt that is available can bless you and lead to good things. Now, obviously, we want to be wise about the debt that we're taking on. We don't want to take on bad debt. We don't want to get ourselves into too much debt, and all debt should have a intention behind it. It shouldn't just be, hey, I think I'm going to make a lot of money, so I'm going to go and spend this money because I want this new car or new clothes or this nice meal at a restaurant. Good debt is one that makes sense from a cash flow perspective, one that makes sense from an equity perspective, and one that does have an ROI, right? So, I mean, in the area of real estate, it is a debt that you take on so that you can buy an asset that's going to cash flow, and then you can also depreciate that asset, which gets me to the fourth pillar, which is tax savings. So all your real estate portfolios should have massive tax savings. If it's not having massive tax savings, you should be doing actively tax planning to see what you can change to get tax savings. And you do that by meeting with a tax planner. So going back to the leverage, just to tie a bow on it, debt is tax-free. So using leverage has multiple benefits. One, it can get you into properties that you aren't able to get into through cash. It allows you to have more equity spread across different assets because you only have to put $20,000 into a property as opposed to $200,000 or $500,000. It allows you to scale at a level that might not be as feasible if you're buying all cash. Now, I am not the bash Dave Ramsey type of guy. I think he approaches business and finances with a lot of wisdom, and he has his reasons of doing it. And most people, when they consider debt and explain away debt, do find themselves getting into trouble. But chances are that's not you. You're wise about your business decisions. You know how to check a deal and make sure it checks out. If it is you, then I would encourage you to go more of Dave Ramsey's approach. But today we're going to be talking more about the taxes. And I say all that because the idea is that your tax plan should be as important to you as your next deal. You put a lot of time and effort into finding that deal that's going to cash flow and appreciate and give you tax benefits and leverage, but you don't spend as much time making sure those tax benefits are showing themselves, are actually showing up on your return or in your financial life. So today we're going to be talking about what you can do from a tax planning perspective to set yourself up for success, to make sure that you're maintaining it at a level that is important to you, that is as important as your next deal, because it will save you tens of thousands, if not hundreds of thousands of dollars. We know that those who tax plan save more in taxes, are more prepared for taxes, are better understanding of their tax situation than those that don't. We have clients or prospects who choose not to go forward with a tax plan because of whatever reason. Some might be because they didn't feel like it, and whatever the case may be, we know that those people that we are offering to work with us can save a lot more money by investing in a tax plan than they can by spending hours and hours trying to do it themselves or trying to find their next deal and make up for the tax savings by just making more money, right? How many entrepreneurs, how many investors, maybe it's you guys approach taxes as, okay, we'll find out what the bill is and then we'll just go and make that money so that we can pay the bill. Because you're great at sales. You can make a lot of money. You know that. It's no secret to you that money is presenting itself at an abundant level to you, the one who has a big tax bill and then thinks to themselves, okay, let's just go and make this. This is 2 sales worth of, or 2 new clients, or whatever it is. But that doesn't have to be your approach. However, for too many people it is, or even worse, too many people are overpaying on their taxes because they're not approaching taxes the way that we would recommend, right? We have client or prospect, that's our prospect, who comes to us and we say, you can save $80,000 by doing a few different things. And then they walk and just find somebody to prepare their taxes because they see that paying for tax preparation is cheaper than investing in a tax plan, even though paying for tax preparation comes with its costs of overpayments on taxes, lack of advice, no communication. Investing in a tax plan has a return that is greater than any investment that you will make in that. So here is the quarterly tax plan. Whether you're a client, whether you're a prospect, whether you are just hearing us for the first time, these are the 4 things that you should be doing. This should be your rhythm on an annual basis. Step 1, quarter 1, you should review past deductions and adjust strategy. So right now we just wrapped up first quarter. We're into second quarter. So in first quarter, a lot of our prospects were reviewing what we did in the previous year. Part of that is also getting the taxes prepared for those that don't go on extension, and then working through it and saying, hey, this is what we did. We implemented this strategy here. This is how much it saved. We implemented this strategy there. This is how much it saved. This is what we did last year. This is what we should do this year. It's reviewing past deductions and making adjustments. So adjusting strategy is also revisiting what you want to do. How many properties do you want to buy this year? What markets are you involved in? And maybe you consider a new market because the short-term rental has a better payoff than the long-term rental. The commercial property has a better payoff than the personal property, right? These are things that you should be doing in quarter 1 to set the trajectory of the current year. Reviewing deductions is just reviewing what we did or what you should be doing but missed out on because you weren't working with us. So whether you're a new client or an existing client, this is what we should be doing. And this is what you should be doing if you have a tax planner that you're working with that's not Better Books. Quarter 2 is optimizing entity structure. So this is largely for clients that this is in their first year, right? So we reviewed the past deductions, we made adjustments. Now quarter 2 is, okay, what do we think about for an entity? What is it, an S Corp? Is it a C Corp? Is it a partnership? Is it a sole prop? There are a large number of options for you as a business owner, as a real estate investor, and we want to review that for you and optimize it to the level that is necessary. And this one oftentimes is just a one-time fix all, right? It's like, okay, we optimize that entity structure. We don't need to make any changes. Now, if you're opening up new LLCs and getting into new business ventures and investing in new properties and getting new entities set up, then we will want to optimize it every year. But this is largely the first year of coming along with us. So long as the entity structure is not the pressing item that we need to fix in quarter 1, quarter 2 is great for it because it gives us some time, right? We don't have to work around the deadlines. We have some time to think about, hey, is it this entity or is it that entity? What are the tax savings that result as a result of choosing an S Corp as compared to a C Corp, and so on and so forth. Quarter 3 should be reviewing mid-year profit analysis and adjusting estimated taxes. So chances are that you are paying into estimated taxes. It can be 100% of the tax burden of last year or 90% of your expected tax burden this year. If you are with us, you get that in your tax return. You have an estimate and it tells you when to pay it and how much to pay it. And then by quarter 3, we can review the profit to make sure that, okay, we said we were going to make this much, we really made this much. Do we need to adjust our estimates a little bit? Or can we invest in something that's going to, say we see that profit doubled of what it was expected, what we budgeted. So rather than $100,000 of profit, you're now $200,000 profit and it's halfway through. The options are 1, pay more in estimated taxes, or 2, consider strategies that's going to bring profit down. I put quotes if you're just listening, but bring the taxable profit down. You are essentially adjusting your strategy, moving money, shifting income so that you can maintain control. You don't have to give $50,000 of taxes to the US. Instead, you can keep $50,000 in-house. Maybe you pay a little tax, but it's worth it because rather than $50,000, you're paying $5,000 or whatever. And now you have that money to invest in the way that we dictate is the best for tax strategy and investment purposes. So this comes in mid-year profit analysis, right? That's why books are so important to keep up with and make sure that you're maintaining them on a regular basis. We just did this with our business, right? And now we did it at the end of Q1 because we're on a level, our entity structure is optimized. We know our deductions, and now it's more just maintaining and keeping up with the profit and the taxable income and the tax at that income level to decide what should we be doing. So we did this, all right? So Q1 ends, we review our profit, we calculate estimated taxes based on those income levels, and it turns out to be X amount. We had Y amount saved, and X was a lot lower than Y, And so because of our tax plan, because of our strategy, because of our projections, we are paying a lot less than what we projected for by just saving a certain amount in every dollar earned. It's our strategy. It's what we do. And if you're a client, you know that strategy and you've worked with it. And so because we oversaved, we conservatively saved, we lived off of less than what we budgeted, we now have a margin between what we would owe in taxes if the year ended today and what we save for taxes. And so now we have an opportunity to pay out dividends, to invest in properties, to invest in other assets, to invest in the business. And that's all just free money, if you will, because it's not going to be, it was set aside for taxes, but we know taxes won't be owed at that level. So now it's like, okay, what do we want to do with this? How do we want to invest it? And in this structure, it's in Q3 because you have to review past deductions and optimize entity structure and get the plan running. And then you review profitability and see what you're doing from an estimated tax standpoint. It gives you freedom, it gives you peace of mind, it gives you security, it gives you margin. Like now you have more money to play with because you know how much you would owe if the year ended today. And it's just amazing to see it come through. Now for our clients who might not be experiencing this right now, the goal is that we are able to bring this to market and improve the already existing services that you're getting. It's in the beta phase, if you will. We want to have proof of concept before we bring it to you guys. But obviously, if you're a client, you're the first one to get that kind of thing. And trust me, Jasmine can give a testimony on that. She was floored when she saw what was happening with our numbers and how it worked out. And then Q4 is final tax saving strategies before year end. So done the deductions, you optimize entity structure, you reviewed profit, made any adjustments there, and now we're at Q4. What do we need to do? Again, it's the same thing. We're checking the profitability standpoint, and we're going to estimate the tax owed, subtract out any estimated taxes that we previously paid, and now what are we going to owe when the year ends, and what can we do to bring that lower while also maintaining our goals, right? Because lowering the taxes isn't always the goal. It's to keep us on path to the goals that we set out for, whether that's buying more property, retiring from our W-2, getting our kids through college, putting money in their Roth account, their 529 plan, whatever the goal is, we want to make sure that we're aiming towards that. So if we come and we say, okay, we have a $10,000 tax bill that's coming up, what can we do to save on that? I can say, go buy a Tesla Cybertruck. But if a Tesla Cybertruck isn't getting you closer to the goal of getting your kids through college, then that's a silly tax deduction. Then we just told you to buy something you don't need to save money that we could have considered other options to mitigate those taxes. And that's why tax planning is so important. And tax planning with somebody who knows your strategy, knows what you want, knows where you want to go and where you've been. Because if I don't know that you want to get your kids through college, or I don't know that you want to set your kids up with an entrepreneur fund, then it could be as easy as invest in this business or invest in this property, even though the more urgent need might be getting your kids through college or putting money aside for retirement. And that's why it's important to work with a CPA, a tax planner, who understands your personal situation and can make decisions, help you make decisions that you're confident in and that get you closer to your goals. All right. So for you guys, the listeners who might not be as versed in this or might not be taking this sort of action, my challenge to you would just be take action. Get with a CPA, get with a tax planner. Maybe you're ahead of the game and you got your taxes filed on time, whether you were happy with the result or not happy with the result, and you just feel like this is something that you can do better. Start doing it right now. It's Q2. You have the whole year minus Q1 to begin implementing and take actions towards your goal. And you can do that by meeting with a CPA who offers tax planning and strategizes with you year round. So take action. That's my challenge to you wherever you are. Don't let it be a once a year panic. Don't let it be a frustration point. It can be one of the most rewarding parts of your business, planning for taxes by wisely approaching your financial situation and then meeting with your advisor to consider what you can do to pay less to the government, more to yourself, and get the highest ROI possible. Until next time, God bless you and keep moving forward.